having you on the second part, or the part 2 of the accounting standard series, looking at IAS 16. Yesterday we started with the discussion, or we started with this season, and then we looked at the overview of all of the standards and how we can connect them. Then I took a couple of questions coming from you guys in relation to various aspects and the various topics that you want us to see, or you want to see more on the channel. And then we started with IAS 16, property, plants, and equipment. We discussed a couple of issues in that case. In case you missed that, you didn't watch that, the link to that is in the description to this video. So after watching this, or you can go and watch that first if you're watching the playback, and then come and watch this as well, because we'll just build on what we started yesterday. So I see some of you joining the stream. Let me know in the chat box. I see some of you coming in. Give us a thumbs up on the video. That way we get more engagement on the video. That is what YouTube wants. And with that way they can share the video or promote the video, so we can reach as many students as possible. So on the video or on the channel page, just click on the like button and make it turn blue. That way we get more engagement. And then let me know in the comments any questions that we have for me. Okay, so let me know if my sound is okay, if my video is okay. Let me see that. If my sound is okay, my video is okay. Is my sound good? Is my video good? Okay, I see. Prince David said, good evening, how are you doing? Prince, I'm doing well, and I hope you are also doing well. Lily Aisha said, hi, how are you? I'm doing well, Aisha. And then Lily said, please increase the volume. Okay. Does it mean my sound is far or not too good? Let me know. Let's see if I can get my microphone. Yeah. Is my sound okay? Is it quite better now? Let me know. More volume. Wow. Let's see. Is my sound okay now? Is it okay? Can you hear me now? Let me know if it is okay, if you can hear me now. Can you hear me now? Okay, so Basil Akan said, good evening. Yeah, good evening, Basil. Pius Ajiman said, another wonderful day. Zolan, I see you. Okay. Laila Aisha said, much better, thanks. All right, you're welcome. I think you sound a bit far, and there is a bit of an echo. All right. Yes, our classroom has a bit of echo there, but let me know. No sound. No, please, your sound. Kindly adjust the volume. Okay. Let me know if the sound still not good. Let me know. Is my sound okay now? Can we go? Is my sound okay now? Can we go? Okay, I guess it's great now. So let's get going in that case. All right. Okay, Prince David, I see you. Thank you very much. Give us a thumbs up on the video when you join, and share the video as well with your friends and colleagues, so we can reach as many students as possible. Okay, so let's see some comments coming in here. Basil Laken said yes. Joseph Entry said it's better, sir. No, son, I just, okay. Christiana, I say you said good evening, Shira. Christiana, good evening. I hope you're doing well. Prince David, okay. Rose T. Bleedy said, good day, sir. Have your lecture started now for the November examination? Yes, our lectures is in session. So you can call or WhatsApp 050-114-9296. Let me open my marker and then pull that down. So you can call or WhatsApp 050-114-9296, 050-114-9296. So Rose T Bleedy, you can, sorry if I don't mention your name right, okay? So you can call this number 050-114-9296, 050-114-9296, and then call or WhatsApp that line, and details will be sent to you. You can join our lectures online via Zoom and also via our study portal as well. Okay, so let's get into the discussion. Now, yesterday we started with the accounting standards and we started with IAS 16. We saw the recognition criteria of IAS 16. We discussed what should constitute the initial cost of an asset by looking at the purchase price and all other direct costs, or yes, all other direct costs incurred in bringing the assets to its present use. And we saw other breakdown, other discussions in relation to what can be included in that initial cost and what cannot be included. From there, we looked at the subsequent measurements where we mentioned that the standard states that IAS 16 states that the entity can adopt either the cost module or the revaluation module. And then we mentioned the circumstances under which either of these modules must be used in that case. And then, so that was where we ended yesterday on the discussion on IAS 16. So like I said, in case you're not able to watch that, the link to that video, yesterday's video, is in the description. You can check it out. Just watch part 1, and then you can watch this to be able to build out your knowledge on that. So let's get into the discussion today, and let's look at depreciation. Depreciation. All right, so Nana Atren, good evening, Nhyira. How are you doing, please? Yeah, Nana, I am doing well, and I hope you are also doing well. Thank you guys for the thumbs up. Those of you who have given us a thumbs up on the video, thank you very much. Let me know in the chat box whatever questions you have for me. Put them in the chat box. I'm going to be reading all of your comments and also reply to them live. So comment in the chat box with all of your questions, and then provide me with the topics you would want me to cover, you would want me to see, you want me to cover or see more on the channel during my live streams like this, so that I can provide you with that better assistance so you can prepare well for your examination. So let's continue with our discussion and let's look at depreciation. So yesterday we concluded that in either case, whether we are using the cost module or the revaluation module, there is going to be what? Depreciation. Now, among other things, there are other terminologies that we need to also understand when it comes to discussing this. So we have what is called depreciation, okay, amortization, depreciation, amortization, impairment, and then depletion. So these 4 terminologies sometimes are used interchangeably, but they have to be understood and used under various circumstances or various conditions. So for instance, when we talk about the issue in relation to depreciation, we are referring to the annual charge of the usage of an asset during an accounting year under consideration, or the spread of the cost of the asset over its economic useful life. That is depreciation. And usually, when we are talking about depreciation, we are dealing with tangible non-current assets. So the annual charge for tangible non-current assets is referred to as what? Depreciation of assets. Then we come to what is called amortization. Amortization also refers to the allocation of the cost of an asset over the economic useful life of the asset. However, amortization is more usable or is more used when we are dealing with non intangible non-current assets. Okay, so when we are dealing with intangible non-current assets, like development costs, like franchise costs, like any other intangible assets, patent costs, and we are amortizing it, then it means that we are charging it over the economic useful life of the asset. So whilst depreciation is for tangible non-current assets, amortization is for intangible non-current assets. I hope that makes sense for us. Then impairment of an asset simply refers to the fall in value of an asset, all right? Or we say that an asset is impaired when the recoverable amount is greater than what? When the recoverable amount is less than the carrying amount. Let me take that again. An asset is impaired when the recoverable amount is less than the carrying amount, or the carrying amount is more than what? The recoverable amount. Then we say an asset has suffered an impairment. Now, when it comes to impairment, we will deal with that later on under IAS 16, where we are looking at impairment of an asset, impairment of intangible assets, impairment of a cash generating unit, and all of these things, and we will get into that under IAS 36. Then the next thing is depletion. Now, usually depletion has to do with the fall in value of an asset as a result of wear and tear or passage of time. Okay, the fall in value of an asset as a result of wear and tear or passage of time. So, for instance, let's say fire guards a factory, or there is a natural disaster, there is flood or something happened, and then something happened, so the machine is destroyed. Then we say that the machine has what? Depleted due to what? The damage that it has caused the machine in that case. So these are the four terminologies that sometimes it appears as though they are being used interchangeably, but you must understand the circumstances under which each of these can be used. I see a comment. Andrew Oponbeko said, please say there is breakage at yesterday's lecture and same happening now. Breakage, really? Are some of you facing any breakage? Andrew Oponbeko is saying that there is breakage in my video. Let me know in the chat boxes if anybody else is facing that. Is it breakage in the audio, breakage in the video, or what? Okay, Lily or Lily Aisha said she is fine. Okay, so maybe Andrew Pombeko, you have to check your network. Joshua Boachi Adam said it's okay now. All right. So I don't know about Andrew Opombeko. You may check your network or something like that, because I don't think I should be breaking. I don't think I should be breaking. So you can check your network and see. Okay. So after we define these terminologies, we are going to be focusing on only one of them. We are going to be focusing on just one of them in that case, and focus on depreciation. So like I mentioned earlier, when we talk about depreciation, there are a lot of methods that we can use to depreciate assets. We have the straight line method, the reducing balance method, the sum of year negates method, and a number of methods. But we're going to be focusing on the first two, that is the reducing balance method and then the straight line method. So straight line method of depreciation, and then the reducing balance method. So let's go. Straight line method of depreciation. Now, when we say the straight line method is a method of depreciation where depreciation is charged on the cost of the asset. So depreciation is charged on the cost of the asset. That is the first thing you must understand when we talk about the straight line method. So the annual depreciation is charged on the cost of the asset. Now, why did I make that statement? I made that statement because sometimes the examiner will say depreciation is 20% straight line. So if he says 20% straight line, it means that we just take 20% of what? The cost of the asset. we just take 20% of the cost of the asset. So straight line depreciation, the depreciation is charged on the cost of the asset. Not only that, number two, when it comes to straight line depreciation, it means that the same amount of depreciation is charged over the economic useful life of the asset. So the same depreciation is charged over the economic useful life of the asset. What does that mean then? It means that if the asset has a life of say 5 years or depreciation will be charged over the life of the asset. So the same depreciation is charged over the economic useful life of the asset. That's the second thing. Then the third thing is that, like I mentioned earlier, a percentage could be given. Sometimes a percentage is not given, so we need to compute the depreciation. Now, using the straight line method, we say that the annual depreciation will be equal to the cost of the asset minus the residual value or the scrap value divided by the economic useful life of the asset. So that is how we compute the annual depreciation. Rose said, which day do you have advanced audit lecture? On Thursdays. So if you are talking about our lecture for the exams, but on YouTube here, we don't have a specific day for a specific subject. It depends on the topics that we received in the areas, and then we'll cover the content on it on the YouTube channel. So that is why I said you can call or WhatsApp 050-114-9296, 050-114-9296, and details will be sent to you so that you can decide. So that is the straight line method. But the entities can also adopt the reducing balance method. Now, what does it mean with the reducing balance method? Now, listen to the name reducing balance method. So number one, it means that depreciation is calculated on the carrying value or the carrying amount of the asset. So depreciation is calculated on, so let's do a zigzag line here, on the carrying value of the asset. That's the first thing. What does that mean then? It means that in the reducing balance method, when we say depreciation is 20% reducing balance, and the straight line method, you would have applied that on the cost. But in the reducing balance method, you will apply that on what? The carrying value of the asset or the carrying amount of the asset. What then does it mean? It means that the amount of value for depreciation reduces as the asset ages. Okay, the value or amount for the asset depreciation reduces as the asset ages. So depreciation reduces as the asset ages, which makes economic sense. Why? Because when you buy an asset today, the productivity of the asset is going to be high in the first year. It's going to be high a little bit in the second year, but as you begin to go to the third, the fourth year, the productivity of the asset begins to what? Fall. In that case, for that reason, it makes sense that in the earlier stage of the asset's life, you charge what? A higher depreciation. Then as the asset ages and its productivity falls, you charge what? A lower depreciation in that case. So depreciation reduces as the asset ages. That is what we mean by the reducing balance method. Then what it means then is that since the depreciation reduces as the asset ages, here we don't have any specific formula in that case. All we will do is that our depreciation is equal to the carrying value of the asset multiplied by the percentage of depreciation, which will be given to us always in the question. So that is the concept about what you need to understand when it comes to dealing with depreciation, either the straight line method or the reducing balance method. Now, yesterday someone asked a question whether the person mentioned that IAS 16, section 16 points, I think, say revenue generating of the entity. I think something like that. And I mentioned that yes, because we don't charge depreciation. That is not a right method, and that is prohibited by the IAS or the standard in the accounting for these. So straight line method, that's what we do. Reducing balance, that's what we do. Now, irrespective of the method that we are doing, double entry is always important, and we need to understand. So when it comes to the double entry, what do we say? We will debit the income statement with the annual depreciation charge and credit the property, plant, and equipment with that. Okay, so that the value of the asset is going to be falling, so we credit it, and then we debit the income statement because depreciation is part of the expenses, and that is going to go into the income statement. Then, once we are crediting the value of the property, plant, and equipment, which will be taken to the statement of financial position. So that is what you need to understand when we talk about depreciation. But you realize that yesterday, as we were talking about the issue in relation to methods or modules to be used, we spoke about the reducing balance method and then the straight line, the cost module. One thing that we mentioned was that the standard states that at least once a year an entity must what? Revalue its assets. So when entities are revaluing their assets, then two things are going to be happening. Either the value of the asset is going up or the value of the asset is coming down. In either case, what will be the accounting treatment? So the next thing we want to discuss is to look at revaluation of assets. So revaluation. So let's look at how we can deal with that. Now, when it comes to the issue about Gabriel Gogu, I see you. You are welcome to the stream with your one eye, with your double eye in the chat box. You are welcome. Give me a thumbs up on the video. If you have any questions, drop it in the chat box. Now, so let's go to revaluation of assets. Now, when we say we are revaluing assets, what does that mean? It means that we are just comparing the fair value, and this is one of the areas that students struggle with. So I want you to make sure you understand what is going to be going down, especially when it comes to the treatment of the revaluation. So two things can happen when it comes to revaluation. We may have what is called upward revaluation. Okay, so two things are going to be happening here: an upward revaluation or a downward revaluation. Remember, like I mentioned earlier, when we say we are revaluing the assets, it means that we are comparing the fair value of the asset against the carrying value of the asset. Now, when we say there is an upward revaluation, what it means is that the fair value of the asset is greater than the carrying value of the assets. So when the fair value of the asset is greater than the carrying value of the asset, that leads us to what is called an upward revaluation. This upward revaluation leads to what is referred to as revaluation surplus or revaluation gain. Okay, revaluation surplus or revaluation gain. What does that mean then? It means that the revaluation surplus or the revaluation gain is going to be equal to what? The fair value of the asset minus the carrying value of the asset. The balancing figure is what is referred to as the revaluation gain. Then a couple of things also that you need to understand here. Under the upward revaluation, this is what is going to happen. The standard states that depreciation should be charged on the revalued amount. Listen carefully. Depreciation, once you revalue an asset, it means subsequent to that, depreciation must now be charged on the revalued amount. Depreciation must now be charged on the revalued amount. That means that there is going to be more depreciation to be charged than we were supposed to charge. Now, let me make that practical for you guys. So let's say the carrying value of the asset is, say, $100 million. And then we've done a fair value, and then now the fair value is, say, $250 million. And then let's say that after the revaluation, we say that the remaining useful life of the asset is 10 years. Okay. Now, what is happening here? Our carrying value is $100 million, but the fair value is what? $250 million. It means that there is a revaluation surplus of what? 250. So revaluation surplus of 150. Sorry, $150 million. Now, the standard states that once we have revalued the asset on subsequent measurement, the depreciation must now be computed on the revalued amount. So what does that mean then? It means that on subsequent measurement, our annual depreciation is going to be equal to $250 million, which is the fair value, divided by the 10 years, and that gives us $25 million. I hope it makes sense. $25 million. Now, had we not done the revaluation, listen to this carefully, had we not done the revaluation, how much would have been the value for our depreciation? Usually, our depreciation would have been 100 million, and that would have been what? $10 million. So had it not been the depreciation, we would have charged, had it not been the revaluation upward, we would have charged $10 million for depreciation. But because of the upward revaluation, now we are charging depreciation as what? $25 million. What it means is that more depreciation is charged than we are supposed to charge. Now, when depreciation goes up, what happens to the profit? The profit falls. So when profit falls, it means that less amount of money will be available less amount of profit will be available to be paid to the shareholders. For that reason, shareholders have to be compensated. So let's build it up. We revalue the assets. There is an upward revaluation. The standard states that depreciation should now be calculated on the revalued amount. For that reason, it means that now we're going to be charging more depreciation than we're supposed to charge. For that reason, our expenses go up and the profit falls. Now, since the profit is falling, it means less profit is available in the retained earnings for the entity to pay dividend out of. So how do we deal with that issue? We deal with that issue by compensating the shareholders. Compensating the shareholders. That is what leads us to what is referred to as the annual transfer. I hope you are getting the understanding so far. That is what leads us to what is called the annual transfer. So if I'm still using this illustration that I have here, so if I'm using the illustration that I have here, then still under the upward, right? So there is going to be an annual transfer. This annual transfer is from the revaluation surplus to the retained earnings. Okay? From the revaluation surplus to the retained earnings. So the annual transfer, AT, will be equal to the revaluation surplus divided by the remaining useful life of the asset. Very, very important. The remaining economic useful life of the asset. So what are we saying here? More depreciation is being charged, hence there has to be an annual transfer so we can compensate shareholders for that excess depreciation that we are charging. So if I'm doing the annual transfer under the scenario, my revaluation surplus, first, I need to find out what is the double entry for that revaluation surplus. The double entry for the revaluation surplus is simply to debit the property, plant, and equipment, okay? Then we will credit the revaluation surplus account. I hope it makes sense. So that is the double entry for the revaluation surplus, the double entry. We debit property, plant, and equipment because it's a gain, and we credit the revaluation reserves. But this is the key thing you need to understand. Even though you are crediting revaluation reserves, that is statement of changes in equity. But note that that will also go into the other comprehensive income. So you are both crediting or going into the statement of changes in equity and adding this to the revaluation reserves, but also that revaluation reserve must be recognized in the other comprehensive income. So you take note of that, it goes into the OCI. Now, note that it is not all the time that the question or the examiner will require you to do the annual transfer. Where it is stated that the entity does it, you go for it. Where it is stated that the entity doesn't do it, hallelujah, you just continue with your workings and then you go away. But where we are supposed to do the annual transfer, then the double entry is that we're going to now debit the revaluation surplus and then credit the retained earnings. Okay, we debit the revaluation surplus and credit the retained earnings. That is very critical. That is very, very important in relation to that. So that's the double entry. So assuming I am referring to our illustration here, what do I have? I'm getting a surplus of 250. So I'm going to be debiting property, plant, and equipment with a 250 million. Is it 250 or 150? $150 million. Then our credit revaluation surplus, $150 million. Then, when there is an annual transfer, we're going to have $150 million divided by the remaining economic useful life, since we are charging depreciation for that 10 years or for that year, and that's going to be $15 million. So it is this $15 million that we're going to be debiting the revaluation surplus, $50 million, and credit the retained earnings, $15 million. Note that this entry actually occurs in the statement of changes in equity. This entry of debiting the revaluation surplus and crediting the retained earnings actually occurs in the statement of changes in equity. So once we have this transfer, what it then means is that when we are now going to the statement of financial position, the carrying value of the revaluation surplus will be the 150, okay, minus the 15. So that now our revaluation surplus will be equal to $135 million. This is what will be taken to the statement of financial position for the year under consideration. So that is what you need to understand about upward revaluation. So when we are revaluing, we are comparing fair value against the carrying value or with the carrying value. And then where the fair value is more than the carrying value, it's an upward revaluation, and that results into revaluation surplus or revaluation gain. The double entry is that we debit the property, plant, and equipment and credit the revaluation surplus. And I said that you need to also credit the other comprehensive income with that revaluation surplus that is going to be coming in there in that case. Then we mentioned that once the asset is revalued, we need to now calculate depreciation on the revalued amount. Now, when calculating depreciation on the revalued amount, it means that more depreciation will be charged than we are supposed to have charged. If you look at the illustration I did here, for that reason, shareholders must be compensated or may be compensated. How do we compensate them? We compensate the shareholders by giving them an annual transfer, by literally reversing that excess depreciation from the revaluation surplus to the retained earnings in that case. And that is where we say that the annual transfer equals the revaluation reserves divided by the remaining useful life of the asset. And that one is debited to the revaluation reserves and credited to the retained earnings. And like I said, this is done in the statement of changes in equity, so that at the end of the financial year under consideration, we will get the carrying value of the revaluation surplus. But let me state that when the revaluation is done at the beginning of the year, then annual transfer will be done for that year. But where revaluation is done at the end of the year, annual transfer will not be done in that year, but will be done. All right, so I'm seeing some comments coming in there. Let me pick them up real quick. Okay, so I see some questions coming in. Let me pick those questions. As I get my video back in a moment. As I get my videos back in a moment. Let's see. Some comments coming in here. Adam said, what factors determine the choice of depreciation methods? Usually, it is based on the nature of the assets. So, for instance, things like building, usually we use the straight line method because usually buildings don't fall in their value. So, we use the straight line method usually for the building. But machinery, plant, and equipment, the more you use them, the less productive they become. So, those ones we use the reducing balance method in that case. So the choice of the depreciation will be based on the assets. Yes, I think we are being assisted to get a feedback, the audio feed, the video feedback. Okay, so that is it about the question for Adams. Then Nayan Gupta said, for solving section C question in CB took me about 50 to 60 minutes. Time allowed is only 30 to 35 minutes. Please give some advice on it. What it means is that if you are taking more time than required, what it means is that you are actually having problems in understanding of what you studied, and you're having challenges with the questions. So what I would say is that you need to increase your speed and accuracy, okay, with the question, and then you need to make sure you understand the concepts there very, very well. Because when you understand the concept there, once you read a question, you know what to do. So yes, continue to do the practice. However, I will also entreat you to work on understanding most of the things there, because that will help you to be able to do. Pius Ajiman said, when the examiner is silent on transfer, what will you do? When the examiner is silent, you also go silent on him, and you can decide not to do any transfer in that case. And like I mentioned, the most important thing is when the transfer is being done. When the transfer is done at the beginning of the year, then, sorry, when the revaluation is being done at the beginning of the year, then there is something you need to consider. Whether you do transfer or not, that will be based on the question. But if the transfer is being done at the end of the year, then it means that, or when the revaluation is being done at the end of the year, then there is no need to do the transfer. Okay. Check and fix this for me.